Parliamentary Committee rejects ban on proof of work, which is a positive sign for acceptance of crypto in the West. Fed hike prediction for the week, etc. Are the top stories today. Stay tuned till the end of the video so that you will not miss any important updates. Welcome to Daily Crypto News channel. The FCA has been warning about Bitcoin for years, but is the real risk not investing? FCA's crypto warning over the years appears to be preventing investors from reaping significant rewards that might be attached to Bitcoin investments. One of the few financial regulators that have been consistent in its warning about the dangers of the crypto space is UK's top financial watchdog, the Financial Conduct Authority, FCA. The agency has repeatedly warned citizens to be wary of crypto investments and sometimes tell those who invest in the space to be prepared to lose all of their money. However, a cursory look at FCA warnings over the years would show that the regulator has not been protecting investors from losing their money. Instead, the warnings appear to be preventing them from making money. FCA Bitcoin warnings and how they affected consumers. UK's FCA's first warning about Bitcoin came in December 2017 when the former head of the agency, Andrew Bailey, said, "If you want to invest in Bitcoin, be prepared to lose all your money." Then, the coin was trading for around $16,000, but the value has since appreciated and at one time traded for as high as $69,000 before dropping to its current market price of $39,176. This means that despite the intrinsic volatile nature of the coin, the FCA warning led those who heeded the call to lose a possible 137% gain on their investments if they had HOD'd it. The agency rehashed its warning in October 2018 when BTC was trading around $6,000. This meant anyone who bought it then would have earned over 500% returns based on the current price. Another instance where the FCA might have prevented consumers from making a massive profit on Bitcoin was in March 2019 when it was trading close to $4,000. The FCA Executive Director Christopher Woolard stated that consumers might not well understand cryptocurrencies and added the usual refrain that anyone investing should be prepared to lose their money. Those who ignored that advice then and bought BTC would have made close to 2,000% returns if they sold during the peak run of the asset. Bitcoin's resilience. While FCA warnings were in good faith, the regulator failed to pay attention to the almost perfect nature of the coin over the years. Unlike other cryptocurrencies, Bitcoin is completely decentralized and is one of the most secure blockchain networks. This is something that the FCA ignored in its studies, leading to its one-sided assessment of the asset and the half-correct predictions. However, the regulator cannot be faulted as it was doing its job of protecting consumers as investing in the crypto space remains at a very high risk. But the paranoia that its warnings generated might have caused many to lose out on significant returns. EU Parliament Committee votes against proof of work ban, supports alternative amendment on crypto assets. European Parliament's Economic and Monetary Affairs Committee has voted against banning proof-of-work-based assets for companies in the European Union. An alternative proposal on crypto assets by European Parliament member Stefan Berger receives support instead. Committee rejects proof-of-work ban. The Committee on Economic and Monetary Affairs, ECON, voted on the proposed markets in crypto assets, MiCA, framework Monday. The proposal includes a de facto ban on proof of work, a last-minute addition to the bill. According to Patrick Hanse, head of the strategy at Unstoppable Finance, the committee has voted against the proposed proof of work (POW) ban. He explained in a series of tweets Monday. The Econ Committee of the EU Parliament just voted against the de facto POW ban. Big relief and political success for the Bitcoin and crypto community in the EU. Overall, 23 voted in favor of the POW ban amendment, 30 voted against, and 6 abstained, he added. As for the entire MiCA draft, Hanse clarified that the final votes were 31 for, 4 against, and 23 abstentions. Unstoppable Finance tweeted, "We are relieved that the Parliament voted against the ban of proof of work-based assets for EU companies." Prior to the vote, lawyer Jake Chervinsky noted that MiCA's POW ban looks like a pretext for a Bitcoin ban. He warned, "Make no mistake, if they manage to ban POW, they'll come for POS, proof of stake, next, and every other Sybil resistance mechanism after that." Alternative amendment on crypto assets supported. Hanse added that an alternative amendment from European Parliament member Stefan Berger received support instead. The amendment reads, "By 1 January 2025, the Commission shall present to the European Parliament and to the Council, as appropriate, a legislative proposal to amend Regulation (EU) 2020 by 852 in accordance with Article 10 of that regulation, with a view to including in the EU Sustainable Finance Taxonomy any cryptoasset mining activities that contribute substantially to climate change mitigation and adaptation." Berger tweeted after the POW ban votes that this is a first-stage win for MiCA. He added that by accepting his proposal, EU Parliament members have paved the way for future crypto regulation. Regarding whether there are still any chances left for the proof of work ban, Hanse explained. The groups that lost the vote have one last option. They could veto a fast-track procedure of MiCA through the trilogues and bring the discussion to the plenary of the Parliament. They need 1/10 of the votes of the EP to do so, which they have. He noted, even outside of this MiCA regulation, the discussion around POW regulation is far from over. What do you think about the EU Parliament Committee voting against the proof of work ban? Let us know in the comments section below. Investors predict Fed to hike rates this week. Reactions from crypto, stocks, gold market expected. The U.S. Central Bank is expected to raise its target Fed funds rate on Wednesday for the first time since the onset of the pandemic. Analysts and economists are hyper-focused on this key event as the Russia-Ukraine conflict continues in Europe. If the Federal Reserve decides to increase the rate by a quarter percentage point from zero, investors wonder how stock markets, crypto prices, and investments like precious metals will react to the news. A 25 basis point increase is expected. Anxiety revolves around the Fed's next moves. Last week, the world watched as financial sanctions were used against Russia, and the price of gold soared to an all-time high, reaching $2,060 per ounce. Energy stocks, oil, and a myriad of commodities also jumped considerably in value during the last 7 days. Cryptocurrency markets last week were lackluster, volume is down, and action remained flat after a brief price jump on 9 March 2022. Stocks, on the other hand, suffered a great deal, and indexes like the NYSE, Dow Jones, S&P 500, and Nasdaq all closed the day in red on Friday afternoon, EST. Making matters worse, data stemming from the U.S. Labor Department's Consumer Price Index, CPI, report shows consumer prices tapped a 40-year high at 7.9% in February. A key event this week for all of the aforementioned markets will be on Wednesday. That's when the U.S. Federal Reserve is expected to increase the benchmark bank rate for the first time since the COVID-19 pandemic. The increase is anticipated to be a mere quarter-point hike, but investors will also be wondering if the Fed reveals a series of rate hikes for the rest of the year. During a panel discussion on 11th March, Oxbow Advisors managing partner, Ted Oakley, said he expects a 25 basis point increase this Wednesday. I want to look at what we might see happen with the Fed. Obviously, next week, we're expecting a 25 basis point increase there, Oakley said. A lot of concern that we saw the market still didn't seem to be that settled about what the Fed might do next. How do you plan around this? How do you position your portfolio when you are not really sure how aggressive the Fed will be? Fed Watch tool predicts 25 basis point increase. Report shows futures markets predict an aggressive series of rate hikes. CME's Fed Watch tool is also expecting the U.S. Central Bank to raise rates by 0.25 percentage points. A Bloomberg report published on Sunday further details that after the first rate hike, the Fed could get more aggressive. Futures markets show around 165 basis points of tightening this year, or the equivalent of at least 6 quarter-point increases, Bloomberg's Craig Torres and Olivia Rockman explain. At the House Financial Services Committee meeting on Tuesday, Moody's Analytics chief economist Mark Zandi said he thinks it's a good idea to move forward normalizing rates. At the meeting, Zandi stated, to ensure that the economy continues to expand and avoid recession, I do think that it's important to normalize interest rates. Crypto markets remain lusterless, gold sheds 3.49%, monetary easing tactics to end. On Sunday afternoon, the price of 1 ounce of gold is lower than the $2,060 high it saw last week. An ounce of gold is currently exchanging hands for $1,980 per ounce of 0.999 fine gold. At the time of writing, the global crypto market capitalization is hovering around $1.78 trillion, down to 0.6% during the last 24 hours. Crypto markets remain lusterless, with only a few tokens gathering single-digit gains on Sunday. Digital currency supporters will be watching the Fed's move on Wednesday to see if it affects crypto markets negatively. As far as most reports are concerned, there is not much of a chance that the central bank won't raise its target Fed funds rate this month. Just like the futures markets and CME's Fed Watch tool, most analysts and economists agree that Fed Chair Jerome Powell's and the U.S. Central Bank's monetary easing tactics are coming to an end. Jerome Powell can't really afford to be dovish at this point. It would be inconsistent with what sound policy is and where policy needs to be heading, Derek Tang, an economist at Monetary Policy Analytics in Washington, said on Sunday. What are your thoughts on this story? Tell us what you think in the comments section below. More than 80% of the funds locked in decentralized finance are kept on 5 chains, 21 different DeFi protocols. In mid-March, the top 5 blockchains, in terms of total value locked, TVL, in decentralized finance, DeFi, currently command more than 82% of the $198 billion TVL in DeFi across all blockchains. Each of these chains offers different types of DeFi protocols like decentralized exchange, DEX, platforms, and lending applications, allowing people to designate their finances in various ways. 5 blockchain networks, 21 DeFi protocols. Today, there is just under $200 billion in DeFi, and that's just the total value locked, TVL, as it doesn't include the large quantity of tokens tied to these specific protocols. Right now, 5 different blockchain TVLs represent 82% of the $198 billion locked in DeFi protocols. The chains include Ethereum, Terra, Binance Smart Chain, Avalanche, and Solana. Ethereum. Ethereum currently holds the largest TVL with $108.51 billion or 54.59% of the value locked in DeFi protocols. On 14th March, the top decentralized exchange, DEX, platform tied to Ethereum is Curve Finance, with its $17.72 billion in TVL. Ethereum's top collateralized debt position, CDP, application is MakerDAO, which is just under Curve as the second largest TVL in DeFi today. In terms of liquid staking, Lido is the top DeFi protocol, and Convex Finance is Ethereum's top protocol for yield. Lastly, Ethereum's largest lending protocol is the DeFi application Aave, with its $11.35 billion TVL. Terra. The second largest chain in terms of TVL in DeFi is Terra, with $25.79 billion or 12.98% of the aggregate TVL. Terra's most popular DEX is Astroport, and Lido is the largest in terms of liquid staking. In terms of yield, Pylon Protocol is Terra's most popular product, with the highest TVL. Currently, there is no CDP application for Terra, but the blockchain's largest lending application is Anchor, with $13.03 billion total value locked. The DeFi lending protocol Anchor has seen a 63.23% TVL increase during the last 30 days. Binance Smart Chain. The Binance Smart Chain, BSC-BNB, is the third largest blockchain today in terms of DeFi TVL with $11.73 billion or 5.9% of the aggregate held in DeFi. The top DEX on BSC is PancakeSwap, and the largest CDP application is the Mars ecosystem. There is no liquid staking via BSC, but in terms of yield, Alpaca Finance is the largest on the network. When it comes to DeFi lending, the largest protocol in terms of value locked on BSC is Venus. Avalanche. Avalanche holds the fourth largest position in decentralized finance this week with $10.88 billion or 5.47% of the $198 billion locked in DeFi protocols. Today's top Avalanche DEX application is Trader Joe, and the blockchain's most popular CDP is Defrost. In terms of yield, the protocol yield Yak is the leader on Avalanche, and Benki holds the top liquid staking position. Like Ethereum, Aave is the biggest lending protocol on Avalanche at the time of writing. Solana. Lastly, Solana is the fifth largest DeFi blockchain in mid-March 2022 with a $6.69 billion TVL or 3.37% of the aggregate held in DeFi today. Solana's top DEX is Serum, and the blockchain's CDP leader is Parrot Protocol. Marinade Finance leads Solana's liquid staking apps, and Quarry is the leading protocol in terms of yield. The largest lending application on Solana this week is Solend with $575.3 million locked. Besides the top 5 chains, there are still dozens of networks and 862 lending, CDP, yield, liquid staking, and DEX applications to choose from. While the 5 different blockchains and the dozens of aforementioned protocols are where most of the money is in DeFi today, there is a large assortment of other blockchains and applications available. At the time of writing, there are 384 DEX applications that allow people to swap coins, and there are 125 lending DeFi protocols that allow people to borrow and lend crypto. 328 DeFi apps offer some sort of yield, and there are 16 different liquid staking apps. Furthermore, there are at least 30 different CDP protocols that issue stablecoin assets via collateralized backing. What do you think about the top 5 blockchains offering different applications for DEX platforms, CDPs, liquid staking, yield, and lending? Let us know your thoughts about this subject in the comments section below. Thank you for watching. Subscribe to our channel and press the bell icon for regular notifications when we post a new video. If you like the content, kindly share this video with your friends and press the like button. Happy learning!